Welcome to Market Call. Thanks for joining us on this Monday. I'm Marella Fernandez. Teal Linde on the show today. He's manager at Linde Equity Fund, and we'll take your questions on North American mid and large cap stocks. Here's how to reach us. 1-855-326-6266. If you want to dial in, you can also email your questions. marketcall@bnnbloomberg.ca. Teal, good to see you. Thanks very much for coming in on this Monday. Let's talk about the news of the day off the top, which is this, I guess, pause on tariffs, or most of the tariffs between the U.S. and China. We are seeing the market move on that. So how much are you reading into this?
Well, it's probably more of a relief rally because, I mean, with the 145% and 125% tariffs, it was really an embargo. I mean, nothing was really being traded. And so they've taken that off. But we have to remember it's a 90-day pause. And after Liberation Day, when he had the tariffs on most of the world, that was also dialed back for a 90-day pause. So when you get up to the 90 days, when the 90 days is up, then you have to start to wonder what's going to happen then. Yeah.
He seems fond of that 90-day pause just to push things down the road a little bit. Let's also talk about what trends you've noticed as the markets have started to come back over the past 6 weeks or so.
Yeah, well, I think one of the interesting trends is just the behavior of corporate insiders, institutional investors, and retail investors. Okay. And I mean, typically, when there's a massive downturn in the stock market, you usually see insiders stepping in. But with the recent, when the S&P fell 19%, insider buying by corporate executives and directors was very, very quiet, and which was pretty unusual. And then also, when the market was going down, you had institutional investors and retail investors selling. But within a few days after April 2, retail investors started becoming very active on the buying. And Vanguard released information that said they were, based on self-directed accounts, retail investors that were buyers were outnumbering sellers 4-to-1. And that they were a major driving force in causing the market to rebound and for the S&P 500 to have that 9-day winning streak, which was the longest winning streak in 20 years.
Why do you think the insiders were not sort of coming back on track for that?
Well, it just goes to show that they didn't believe this. Despite the 19% drop, the insiders did not believe that the prices were down enough. Because they will buy when they believe that their share prices are undervalued or they expect strong growth ahead. And so that wasn't there. Now, the retail investors, they were actively buying because the last 15 years, they've been conditioned to believe that buy the dip.
Sure.
It's worked almost every time. And so that's been a driving force for the recovery.
Okay, so we've seen some of that timing out. What do you expect in the next? We're still in the pauses, as you mentioned. So how long do you think the momentum could last?
Well, I mean, probably a day or two, perhaps. We've seen these sort of euphoria of some good news, and then after the next day or two, it starts to pull back. And so I think we'll have an indication because the 90 days that was given to the rest of the world was soon after, in the first week of April. And so that brings us to early July. And we'll see how that goes. I mean, if that goes well, then perhaps there's probably potential for the China and the U.S.-China tariff discussions, which are going to go 90 days from today. We'll have an indication of how that might go.
Yeah, so it could
early July
well for the later times.
Early July will give us an indicator.
Got it. So we have a little bit of a grace period in between. All right, We're going to be back with Teal Linde, manager at Linde Equity Fund. He's taking your questions today on North American mid and large cap stocks. We're back in a moment. Welcome back. We are getting straight to your questions. We have one from Al in Montreal through an email. He says, Uber has had a bit of a rough ride lately. What are your thoughts on Uber? We've talked about Uber a few times in the past, just about there is growth potential for them, but what's going on with them more lately?
Well, they're making inroads into resolving the whole debate between whether robotaxis are going to be a threat or something that they can coexist with.
Got it.
And so they recently announced partnerships with two robotaxi companies that manufacture self-driving vehicles out of China, Pony AI and WeRide. And so that's going to allow them to, it really sort of suggests that as more companies create robotaxi fleets, that they'll probably want to partner with Uber. Because I think most people do not want to have 5 to 10 mobility apps for every robotaxi fleet.
Sure.
They'll want to have one. And so it could be, Uber is sort of heading down in a direction where it could be like Amazon. With Amazon, you don't have separate apps for all these different vendors. You just have one app. And so the potential for Uber to replicate that type of model is quite significant.
Generally, how is that going, the robo-taxi launch? I know in California, they've already got it up and running. They're trying it out in different places, the warmer climates in the U.S. But generally, is it something that people are putting stock in that will happen?
Yes, actually, well, Uber just announced that because they've had about 100 Waymo taxis, vehicles that they partner with in Austin, Texas.
Okay.
And so, I mean, Waymos have, like San Francisco, they have their own sort of app where if you want a Waymo, you gotta go to the Waymo app. But in Austin, Texas, you can go through Uber. And Uber announced that the 100 Waymo vehicles that they have operating there had more drives per day than 99% of the cars that were being driven by, or the Uber cars that were being driven by a human.
Interesting.
Now, so either that's a sign that, wow, people really, really want to do it, and perhaps is that a bright sign of the future? But there were only 100 cars, so you have to debate whether there was a lot of demand because of the novelty.
I also wonder whether or not it's cheaper than having a driver, and that could be one of the reasons people are turning into it, right? They always sort of list cheapest to least expensive, most expensive, and maybe it falls somewhere in between, so people are taking a chance on it.
Well, it is cheaper because you don't have to tip. And there's actually other advantages. I've spoken with a couple of people that have taken these Waymos, and when you used Uber, you sort of request a driver, and then the drivers in the area think about whether they want to accept. And with Waymo, as soon as you request a vehicle, it's instantaneously connected with you. There's no wondering if any drivers are going to do it. There's an algorithm that decides.
Got it.
And then there's no tipping, and so it's faster. And then you get your own private vehicle if you don't feel like small talking with the driver. You have your own space. You have control over the music.
Yeah, so it's like a limousine used to be back in the day, where maybe the windows go up and you're in the backseat by yourself. All right, let's get to the phone calls. We have caller Mike on the line from Toronto. Hi, Mike.
Hi, I'd like to ask about Ensign Energy. Reported earnings today and obviously benefiting from the tariff news. Do you think the bottom's in on this one and should do well from here?
Okay.
Thanks for your call, Mike. Well, interesting, we started off the show talking about how there was hardly any corporate insider buying.
Yes.
Ensign's an exception.
Okay.
On April 3rd, the CEO bought about $100,000 worth of stock.
Day after Liberation Day.
Day after, and then on April 4th, bought another $100,000 worth of stock.
Wow.
And so if you look across the C-suite and the board, the insiders that are the most predictive of where the stock's going to go are when you see insider buying by the CFO, number one, and then the second by the CEO or president. So I think that's a good indication. Whether the floor is in, I mean, it's a commodity-based company, and so you just never know for sure where commodity prices are going to go, so you never really know for sure if a bottom's in on any company that's related with commodities.
Okay, and
but it's encouraging.
Ensign, I was just looking at, I might have missed the chart up here, it was at $2.03. So yeah, he's basically wondering, do I hold on to this or what do I do with this for the longer run? So it is up today a little bit, but it's been hovering around as that low for March and April.
Yeah, we continue to hold it, and I think there's the fact that the CEO is one of the few CEOs that was actually buying stock during the downturn. That's another indication to hang on.
Got it. Okay, let's go back to the phone lines. We have John on the line from London, Ontario. Hi, John.
Hi, Marilla. Hello, Teal. Longtime holder of Pembina Pipeline. It did well during the pandemic, and I had high hopes for it when Trump got elected for the second time. It's been disappointing recently on news, but the news was more neutral than negative, and the investors overreacted as usual. What do you think of Pembina Pipeline, or should I look for greener pastures? Thanks very much.
Thanks for the question.
Thanks, John. I would keep Pembina. We own Pembina, and it's got a really dominant position in the Montney where the natural gas fields are. And so it's going to benefit from all the liquefied natural gas exports coming off the BC coast. It's got a balance sheet that has less leverage than TC Energy and Enbridge. Okay. It's got a pipeline of growth opportunities from now to the rest of the decade, but that can be self-funded from internal cash flow. And they've got a dividend payout ratio that is also more manageable than the other two incumbents.
Do you know what their dividend is off the top?
Well, the yield's about just 5.5%, right? And they're also very diversified. I mean, they've got their own LNG joint venture in Kitimat that they're doing, and they recently announced a joint venture where a data center is going to be built on their land, where they're going to be providing the energy.
Got it. So they've got a lot of good things sort of coming up. You'd suggest maybe hang on to it then?
Yeah, it's got a great track record of growth. It's less leveraged, and with a 5.5% dividend yield and the incremental growth on top of that, it's for a risk-reward play, it's quite attractive.
Are you seeing some sectors come back a lot slower than the others? Tech, we always know there's a lot of enthusiasm. As soon as one thing goes up, everything shoots up. We're seeing pharmaceuticals get hit a little bit today because of more news out of Washington from Donald Trump. Are you seeing some sort of sectors just really hesitant to sort of join the fray?
Telecom.
Okay.
Yeah.
Which has longer problems, historical problems right now.
Yes, but they have, I mean, with interest, what we've seen is like stocks like Fortis, utility stocks, pipelines, their stocks have been running up partially because of falling interest rates and the anticipation of falling interest rates. And you typically see that with telecom stocks, but you haven't seen that. You've seen Rogers actually go down to 10-year lows, and BCE obviously cut their dividend. And TELUS has got a dividend yield between 7 and 8%. And so you'd think that with rates coming down in Canada, they get more of a bid. So the telecom stocks are lagging. But there's also opportunity there. I mean, if rates start to continue to go down, which is a possibility because of unemployment rising in Canada, and then the telecom stocks have some easy upside. Without having to grow their business, simply just having these attractive dividend yields, you're going to attract more bidders to the stock.
Got it. Okay, BCE, of course, parent company of this channel and CTV National News. We're going to take a quick break. Teal Linde sticking around to take your questions. We're back in a moment. Welcome back to Market Call. Thanks for joining us today. Let's get right to the phone lines. Colin's on the line today from Sarnia, Ontario. Hi, Colin. What's your question today?
Yeah, hello, Morella. My question for Teal is about TD Bank. I have a core position, and thanks to the tariff charades, I think I want to expand it, maybe double my weight. So I'm wondering if Teal would see it as an overweight stock in, let's say, the next year or so.
All right, thanks
you.
for the question. So TD is climbing back. Was 84 last time I looked, now up to 88. What's your take on TD?
TD Bank is an example of, there's a saying in the stock market, like last year's loser is this year's winner. And TD was a big loser last year.
Sure.
And it was recommended as a top pick. And last year was, I mean, back during last year was the year where you could have made a larger weighting. Because right now, TD Bank is the only Canadian bank that is up this year. It's up about 15%, and all the other banks are either sideways or down. And so given that it's already up 15% in just 4 to 5 months, year to date, I'd be hesitant about doubling your position at this point. I think that given the fact it's up 15%, if you look at the valuation, it looks like it's probably going to be at this level for a while. It doesn't really deserve to go up much more, or maybe it doesn't go down as much, but it's sort of, the gains for this year are kind of in place. And then at the end of this year, you can see where things are at and consider adding perhaps in the fall.
Okay, so the bounce back from sort of December, November has happened already, and you think it'll go sideways for a little bit?
For a bit, yeah.
Okay.
Take a breather.
Got it. Let's go back to the phone lines then. Nazar's on the line from Scarborough, Ontario. Hi, Nazar.
Hi, Marilla. Hi, Joe. May I have your thoughts on Enbridge, please? Is it a buy here? It has extensive operations in the U.S., which makes it less vulnerable to tariff threat, I believe, compared to Pembina pipeline. I listened to your comments on Pembina earlier, which was your top pick not too long ago. Thanks for taking my call.
Thanks, Nazar. So Enbridge right now, 61.94. So down today, $2.36 or 3.7%, but generally has done well. What's your take? Would you pick it up at this point?
No, I wouldn't. It's run up quite a bit, and if you look historically where it's traded at in the past at its peak, the valuation today is similar to where it has sort of peaked out in the past.
Okay.
And the pipelines, even though the pipeline industry and pipelines that are companies are quite stable, their share prices are quite sensitive to expectations and interest rates. And so I do believe that Enbridge has benefited from that. TC Energy as well, but TC Energy is more natural gas focused, and so there's a lot of more bullish news for natural gas. Enbridge is considered the oil pipeline, but they do have a lot of exposure to the natural gas and liquids as well, but they are heavier towards oil.
What did you think of his comment that because they have other markets, they're not as exposed to the tariffs from the U.S.?
No, that's a fair deal, because even when the Trump administration was talking about tariffs in Canada, when there was 25%, they did decide to lower it down to 10%.
For energy.
For energy. Energy had some favorable treatment. And in the end, that 10% went to zero. The 10% was then applied to the rest of the world.
Got it. Okay, let's go back to the phone lines. Diana's on the line from Regina today. Hi, Diana.
Hi. Thanks for taking my call. My question today is on TFI International. I was just wondering, it had the major pullback in February there. Obviously, the trade war is hurting transportation, but at these levels I'm buying, and I'm looking for a full recovery in 1 to 2 years. I just wonder your thoughts on that. Thank you.
Thanks for your question. Okay, let's pull that up.
All right. Well, I would endorse as a speculative buy. I mean, it's always difficult to be buying a company that's in the middle of a recession, right? But that's when the sentiment is typically the weakest. And in hindsight, you're always like, oh, I should have bought it then, when everyone thought it was a terrible place to be. Because the stock, historically, the freight recession has been in place for a while. It just didn't appear in the last few months. It was there last year. And so I was always curious why that TFI was holding up so well when there's all this recession talk. And of course, reality sort of set in, and the stock is down almost in half. And so at these levels, for someone to be buying, I can't argue against that.
Freight recession last year as well?
There was, yeah. It was a freight, yes, it was.
What led into that?
I think during the pandemic, there was a lot of demand for freight. And you remember, the industrial REITs were really busy. There was a lot of demand for freight and storage. And so a lot of the freight companies bought more trucks. And of course, it ended up being an oversupply.
Got it.
And so that oversupply has to get worked out. And it'll take a little while, but you can't wait for it to have worked out, because by that time, the stock will already be up. So it takes some courage to be buying stocks like TFI when everything looks so gloomy.
Got it. Okay. It depends on if he has that courage. Let's go on to Anne, who's calling from Scarborough, Ontario. Hi, Anne.
Hello. Teal, I recently bought Cameco, and I'm very pleased. I realized that Cameco and Brookfield Asset Management bought Westinghouse. Would you recommend I buy shares in Brookfield Asset Management? Thank you.
Thanks for the question, Anne. Sorry, I was just looking up Cameco before that, but what's your take on Brookfield? I mean, it's fairly solid.
Yes, it is, but I would suggest buying the parent company, Brookfield Corporation, rather than Brookfield Asset Management. Both are solid companies, but I think you get a bit more when you buy Brookfield Corporation, and which owns 75% of Brookfield Asset Management, but it owns other businesses as well. And the valuation of Brookfield, you could argue, is a bit more attractive than Brookfield Asset Management. And plus, the corporate insiders, they generally own shares of the parent company, not necessarily as much in the satellite companies such as Brookfield.
They've come back quite a lot from the March-April dip, so they're already up to 81 to 87. Would you still buy in? I mean, they're still down overall over the past couple of months, but would you buy in at this point of 81, 88?
It's difficult to buy anything that's shot up like this, but as a long-term hold, you can start picking away. I mean, preferably you identify this is a stock I want to own, and you wait for a pullback, right? And if you have the patience or you have the flexibility to do that, then that's what I would do. But I do believe that the long-term outlook for the company is strong enough that even if you did buy it today, five years from now, you'll be happy you did.
Got it. Okay, so maybe dip in and then keep an eye on it.
Yeah, to start opening a position and start accumulating. It's one of these stocks where I think people should own as a core holding in their portfolio, because they announced in their investor day last September that they expect I'm talking about Brookfield Corporation, they expect their distributor earnings to grow at a 17% compound annual rate over the next 5 years. And that's not including the carried interest. If you include the carried interest, they are forecasting 25% compound, which is quite phenomenal growth rates for a company of its size. But they have credibility because shareholders have earned a 15% compound annualized return owning stock over the prior 10 years.
Okay, so people like them, they're solid, dip in, and then let's see where it goes from there.
Yeah.
We do have to take a quick break. We're going to be back with Teal Linde in just a moment. Stay tuned. Back to Market Call. We are going to go through Teal's past picks from May 13th, 2024, so a day off, almost a year ago today. At the time, he had picked Kinsale Capital on the New York Stock Exchange. It was $375.41 American at the time, now up to $447.79, so a 19% return and 19% total return. Can you tell me a little bit about Kinsale? I know they're insurance providers, but are they quite specific to a sector?
Yes, they do excess and surplus. So the property and casualty insurer, focusing on excess and surplus, which is basically specialty insurance. And so which is specialty insurance is non-standardized insurance, where you can basically price whatever the market can bear. And so if you do it properly, it's actually more profitable than what standardized insurance companies can do.
Okay, so they're quite a bit up, almost 20%. I'm just wondering if you still like it as a stock.
We do. I mean, this is 20% is kind of in line with how the company's been growing in recent years. But I think this year is probably going to be a bit of a pause going forward because it did very well in commercial real estate because of all the increasing frequency and severity of natural disasters and then the inflation and the cost of construction. And so the insurance companies across the board benefit from that, and including Kinsale. But that's sort of dying down. And so, but that's only 20% of their business. They got 80% of the other business that they're investing in that can continue to grow. But I expect it to be a bit of a pause for a little while. But we continue to own it and like it long term.
Got it. Okay, let's get to your next pick from May of last year. 5 below 5, recommended at 140.03 American, and down now to 198. So 28% drop, 28% total return drop. And this is what I would have called like a doodad company, right? They have all these deals, mainly for tweens and teenagers, sort of things little tech toys they can use, and clothing they can use, leisure, fashion, that kind of thing.
Yeah, you know it well.
And
it's also part of the dollar store category.
Got it.
Right? It's often considered a dollar store for tweens and teenagers. And in the United States, the dollar stores got hammered last year, and Five Below was one of them. But there's reason to be optimistic still with this company, in that for March and April, they sort of pre-guided their current quarter results, and they said their same-store sales are up 6% instead of 1%.
What do you like about them specifically?
Well, we've owned it for a number of years, and what we liked about them in the past was that they were growing their store count by 15% per year.
Got it.
They have like a 1-year payback, and they were expanding across the U.S., and they had visions of doubling their store count. And then last year, everything sort of collapsed, and they cut their store growth from 15% to 9%. So that's a big change to the sort of the growth model. And then the CEO, who was talking about 15% for another several years, left the company. And so they've had to reset and sort of reconfigure how they're doing the business. So we have taken some profits in the past, but we're actually looking to exit this company at some point because the saturation of the stores is going to become a growing concern as the years go by.
Got it.
Yeah.
Okay. Let's get to your third pick from last May then, which was Linamar on the TSX, of course. Linamar at 71.83, now 61.70, 14% drop, 13% drop return. Linamar has come out recently and said they're not really affected by tariffs because they're part of the CUSMA cutout, right? Which is the carve out, which is great for them.
Yes.
But they got dragged down with everything else in the initial sort of announcement of tariffs across everything.
Yes, they did. And but also, this is a company that's very well managed. They've had a lot of good years in the past, and we've owned them for a while, but we've actually decided to part ways with Linamar.
Okay.
And again, nothing against the company. We think it's a great company, well managed, but it's been having a very hard time getting respect from the market. I mean, particularly last year. Last year they had a great year, double-digit revenue growth, double-digit earnings growth, and yet it's still traded at a single-digit PE, where it sort of still trades today.
So it did get a bounce apparently after the earnings last week, which of course, when they announced they weren't really affected by the tariffs much and they can handle it.
Yeah.
But beyond that, you don't think they're getting treated?
They've had a lot of the great announcements over the years, but they just don't get the respect of the market. So, I mean, you and I could think our company is really, really impressive and all that, but if no one else is enthusiastic as us, it's going to be hard for the stock to move. And I kind of feel that there is a dedicated fan base for Linamar, but it's not big enough to cause the stock to go up, in our opinion. So our only exposure to auto stocks now is BYD out of China and Uber.
Got it.
If you can call Uber an auto stock. But
yeah, it's a hard one to get into right now. We do have to take a quick break. Teal Linde's going to stick around to take more of your questions. We're back in a moment. Welcome back. Thanks for joining us here on Market Call. Right back to your phone calls. Mike's holding on the line from Toronto. Hi, Mike.
Hi, guys. And Teal, what do you think BCE can rebound to now its divvies being cut? Also, as someone who depends on divvies, should I sell it at a loss, a substantial loss, and put it into one of the maybe higher paying dividend REITs available? I'll listen.
Okay. Thanks for the question. A lot of people have questioned the telecoms in general. BCE, the parent company of this channel, and the CTV National News under Bell Media. They reported earnings. They cut their dividend, which was widely expected, and they're at 31.58. So they pushed past 30. They were under that before. Mm-hmm. What's your longer-term take on BCE?
Well, for BCE, I often look at the U.S. telecom, like Verizon and AT&T, and BCE's valuation is kind of in the middle between the two.
Okay.
So in terms of where it goes from here, I think it's probably fairly priced. Again, what could lift BCE stock is if interest rates continue to come down, because the dividend yields now are the highest dividend yields now are offered by the telecom stocks, generally speaking. And so
even with the cut?
Even with, with the cut, I think what the yield is about 5.
They cut it 56%.
Yeah.
So yeah. They're down to, it was 17% or something like that, wasn't it?
Yeah, no, I think the yield is still attractive at this stage. I mean, TC Energy, the pipeline's dividends have come off. Like Fortis is at under 4%. And so telecom is really where you can get the richest dividend yield. So the best thing that could happen for BCE stock is if interest rates would come down.
So I guess he's wondering, though, does he sell at a loss and go for something else, or just stay in it then? Would you say stay in it for the dividend at this point?
Well, I mean, I'd have to look at the rest of the portfolio and what the other contenders are, what he does or doesn't have. But you could BCE could be a hold, but you might want to take a look at Rogers. I mean, Rogers is trading around 7.5 times earnings, and the dividend yield is 5.5%. See, Rogers' dividend yield is not as high as TELUS, but their payout ratio is less than half of TELUS, for example. Rogers could double his dividend, and the payout ratio would still be less than what TELUS's payout ratio is.
Okay, it looks like BCE is still quite up there. I've got 12% for the dividend there.
So it'll be about 5, and if you take 55% off, you'll be able.
All right, let's go back to the phone lines. And Dominic's on the line from Montreal. He has a question today. Dominic, what is your question?
Yes, hello. Thank you very much for taking my call. My question is on Alphabet. I own 4 of the mega cap stocks, and I don't know of any financial advisors that would recommend selling a company like Google, and I don't plan to sell. But what intrigues me is that it's a growth company that's been selling at value prices since February, and even on good days when the other mega cap stocks really shoot up, Google shoots up just a little bit. It has trouble staying above 160 since February. I just wonder, a growth stock at value prices for this period of time, can you give me some of your insights why that might be?
All right. Well, thanks for your call. The reason why it's trading at a valuation or as like a value stock is 2 reasons. There's all these concerns about antitrust issues where the company might get broken up, and so that's caused a sell-off. Even though you can make the case that if you did break up the whole company, the value of the parts would be worth more than what the company's trading at today. But that's one source of what's weighing on it. The other one is that a lot of concern about how these AI chatbots and Perplexity and OpenAI and others are taking away share on the search side of Google's business. And that's another thing that's weighing on it, because more people, it's true, there are other search engines out there that people are using, but the distinction has to be made that currently a lot of that search that people use for OpenAI, for example, I mean, Google says that we've lost a lot of inquiries for doing homework or math.
Yes.
I mean, there was no ads that are going to be sold when people go and use no longer use Google for doing their homework or school assignments, right?
Yeah.
And there's a lot of knowledge-based information-seeking queries that there's no commercial intent. And so Google's commercial intent inquiries are still there. I mean, they had 14% revenue growth just last quarter on a constant currency basis, so it's good. But what happens, the risk is, though, is if the agentic AI starts to happen, where these other search engines where you can start looking for your commercial intent queries for you, then that could become a problem. And so that risk is what's weighing on Google stock. So we own Google stock, and so the debate we have is that, I mean, the company just invested $75 billion in capital expenditures. So it's difficult to dislodge an incumbent, but the growth rate could slow down. And so it's really a discussion of how much of a weighting should you have of Alphabet in your portfolio.
Got it. Okay, a lot to consider on that one. Let's move on to Jeff, who's calling from the line in Edmonton today. Hi, Jeff.
Good morning, Morella. Thanks very much for taking my call. I wonder if I could get Teal's input on Dollarama, please.
Dollarama, you were talking about some of the dollar stores, I guess stateside being hit last year. How have we done in Canada, and what are you looking at for Dollarama?
The Dollarama's been a phenomenal success story. It's actually one of those stocks that you kick yourself for not buying 10, 15 years ago, because it's had a fabulous run. But it's getting very expensive. It's trading around 37, 38 times this year's expected earnings. And the growth rate's not that tremendous. I mean, it's still a single-digit revenue grower.
Okay.
But they are growing. I mean, they're having success expanding into Latin America with Dollar City, where they have operations where they have a controlling shareholder of Dollar City, which operates in Colombia and El Salvador and Guatemala,
okay.
And they're expanding into Mexico. They recently did an acquisition. So I guess they're basically, what you can give them credit for is they're taking their successful business model in Canada and taking it overseas.
Is this the Australia
Yeah, they just did a buyout in Australia.
That's
they
right.
bought a company that has about just under 400 stores called the Reject Shop.
That's right.
Hopefully they change the name.
But I mean, it seems to work well.
Just changing the name probably. Well, they've talked about remarketing, but they're going to bring in the business model success and transplant it into these other countries.
And is this the farthest they've gone? You mentioned sort of some of the Latin American companies that they are starting up in. Is this the farthest they've gone to try and export their product?
Yeah, they're not necessarily exporting the product. They're running
model.
The model. Yeah, Latin America, and now most recently Australia, where they expect they can actually increase the efficiency of those stores and expand the number of stores that operate in Australia.
Got it. Okay, we are going to take another quick break. Teal Linde sticking around. We'll take more of your questions. We're back in a moment. Thanks for joining us on Market Call. We want to get back to your phone calls for Teal. Sal is on the line in Toronto. Hi, Sal.
Hi there. Yeah, my question is on cargo jet. I was interested to know if this would be a good time to enter, given it seemed to have a bit of a bump recently. I guess it's the China news, but just wondering if now's a good time. Thanks so much.
Was cargo jet hit by sort of the tariff talk and maybe fewer flights going back and forth? Was it hit by that?
Yes, all the economic uncertainty contributed to its pullback. And
so it's down to 94.
Yeah, it's down quite a bit compared to where it's been in recent years. And so to the caller's question, I think that it's in a range where you can accumulate some shares. I mean, it's sort of a slow and steady type company. I mean, it's a very secure company. They basically dominate the overnight courier business, express in Canada.
Okay.
With their freight. I mean,
do they go
Amazon
across the border as well, or are they primarily in Canada?
Primarily, well, I'm not sure about that, but I know that they sort of dominate within
the
Canada
trade. Okay.
Because that company is operating in one of the industries that's protected by the government, right?
Okay.
And so you can't have foreign airlines coming into Canada, as you know, and flying from point to point in Canada. So that's how they have that domination. And so that's why FedEx, Amazon, DHL use their services. So they're quite secure there. But because they're so dominant, you are kind of growing with the state of the economy. I mean, they are looking for ways to expand into underserved areas. So given the valuation where it's trading at now and how secure the business in their dominant position, I'm good with opening a position.
Could they benefit from the work to reduce provincial barriers to trade? Or is that not really a big enough movement that would affect them?
Good question.
But they're all trying to bring down those barriers. We
yes.
could see more things go across the country. That seems to be a goal, but I'm not sure how much it would actually reflect in drastic amounts of trade moving by air across the country.
That's correct. What the products are and what the need for speed. Does it need overnight delivery across the provincial borders, or can it be delivered by train or truck?
In a week or two, exactly.
Yeah.
Okay, so that would be the difference. All right, let's go back to the phone lines. John's on the line in Toronto. Hi, John.
Hi, I need to ask a question. If I put in $4,000 to NASDAQ, how much money will I earn?
Wow, that's a very specific question. I'm not sure you can put a detailed answer to that, but well, I guess how is the NASDAQ doing and what's the expected growth?
Well, I mean, the NASDAQ 100 would be one way to, if you wanted to buy the NASDAQ, typically people buy the NASDAQ 100 ETF. And I guess you could argue that everyone should have exposure to the large cap tech.
Okay.
Right? And you don't have to own all the companies. I mean, if you want to own individual companies, you can do that. Or if you don't do that, you can just buy the NASDAQ 100. You can do that as well.
Talk about the benefit of the ETF under the NASDAQ as opposed to individual stocks.
Well, the advantage, if you're not in a position to sort of do your own analysis of the individual stocks and determine which ones are attractive valuations and their growth prospects and all that, if you're not in a position to do that, and then you can buy an ETF would be your next best bet. And when you buy the NASDAQ 100, you are getting exposure to the large cap tech stocks, which are in a position to likely continue to grow over the years. But you don't want to own too much because the NASDAQ tech stocks are also the most volatile. Mm-hmm. So,
but do you strip out some of that volatility by buying the ETF? So you're going to get the gains, but not as much volatility as an individual stock, or is that dependent on the stock, of course?
They're both quite volatile.
Okay.
Yeah, and you see what happens. The NASDAQ 100 is really dominated by the large cap techs make up a sizable amount of the NASDAQ 100. So they sort of coincide, and the movements are fairly similar with both.
Got it. Okay, let's go back to the phone lines. And Gulam has a question. She's on the line in Toronto. Hi, Gulam.
Hi there. Good afternoon. My question is on Bank of Nova Scotia. I bought it a while ago at $78, and it's trading at about 68 right now, I guess. And they're paying a 6% dividend yield. I'm just wondering whether I should buy some more and average my costs down, or just wait and see. I'd like your opinion. Thank you.
Thanks for the question. So it's at $70. I have it at $70.73 or $70.70, down quite a bit from the start of the year, and a little bit of the upside today. What's your take for Scotiabank, and do you think it'll come back? It was, it was at 79 at the end of last year.
The caller's question was whether buy more or wait and see.
Exactly.
I would wait and see, because Bank of Nova Scotia is one of the banks that's sort of undergoing a bit of a repositioning or a turnaround to a certain extent.
In what way?
Well, because Bank of Nova Scotia used to be the bank that was the overseas bank. They used to be operating in 30 different countries, and so they've really dialed that back. And so now they're going to be focused on Canada and the United States and Mexico. But my concern is that for them to sort of come back and focus on Canada and the United States is that it's already pretty crowded. And so I'd like to see how they can manage to do that in a way that's going to be profitable for the bank. Now, one of the things they've done is they're going to be acquiring KeyBank in the United States, which is a regional bank. And KeyBank's another bank that's been struggling. So at least they're not paying a premium for a bank that's been very successful, where we've seen banks do that, and then things don't quite work out, and it turns out to be a bit of a loss. And so, but whether Bank of Nova Scotia is in a position to help a U.S. regional bank turn around is kind of the wait-and-see moment.
Got it. Okay, let's get one more caller in before we have to go. Carol's on the line from Vancouver. Hi, Carol. What's your question?
Dad's got work for you.
Carol?
Hello.
Hi, Carol. What's your question?
I was wondering about Aritzia, whether that ship has sailed or whether it's a good time to buy.
Okay, we'll talk about Aritzia. It did very well in its last earnings report, sort of quadrupled, I believe, from the quarter last year, same quarter last year. So it's doing well, and they're expanding, aren't they?
Oh, absolutely. I mean, they had their results just came out, and they had over 30% revenue growth year over year, which is phenomenal. 26% same-store sales growth, and their e-commerce business was up over 50%. And so that's really driven the stock up. They did temper their guidance going forward on the earnings because of what's going on. And but then with what's happened with the China news, U.S.-China news, I think that's pushed the stock up. So the caller said, should I buy now or wait? Given how much it's run up, and given that Aritzia has a history of being pretty volatile, I'd wait for one of those days or weeks where it's actually had a downturn.
Is it very volatile for a clothing retail company? Because I would think that they would move in a slower move for retail one way or the other. But why is it volatile?
Because the analysts or not the analysts, but the market is so myopic on any change in the margins, right? Any slight change in profitability, and it causes the stock to really whipsaw.
Okay.
But because you're right, over the years, if you look at a 30-year chart, it looks pretty steady, the growth of the stores and the revenues and all that. But you know, when you close in there, it's just the sentiment swings are there, and because people are so preoccupied in seeing how their same-store sales are doing on a quarter-by-quarter basis. I mean, over a 5-year period, it doesn't really matter if one quarter was up or down, and the long term is what matters the most. But the market is pretty myopic in looking at how things are on a quarter-by-quarter basis, or even on a smaller time period. If they're seeing news that another retailer is not doing well, then they figure, oh, Aritzia might be in trouble, and the stock takes a hit, just out of guilt out of association.
Got it. All right, we are going to take a break right now. That's all the time we have for your phone calls. But Teal will share his top picks. That's coming up. Welcome back. We are now going to take a look at new picks. And we have first on the list Air Canada, which I was surprised at, Teal, because it's been really beaten up, and I had never expected it to go down to that $15 mark, which it did at one point. Even during the pandemic, I don't think it sank that low. So you think there's comeback here?
Yes, I mean, people believed it was starting coming back last fall when it was around $25. And because you're right, it's trading not too far off from where it was in the early stage of the pandemic when the planes were 90% empty.
Yeah.
So the balance sheet's much stronger today. The planes are full. And again, last fall, the airline industry was picking up. And Air Canada at $24, $25 is actually lagging the U.S. airlines, which had gone up even more. But then with all the trade war fears, it's dragged down all the airline stocks. But it looks like the trade war fears are probably overdone because Air Canada announced the results on Thursday after the market. And they said that their second quarter bookings are at 80%, right? Advanced bookings, which is similar to where they've been historically.
Except that people aren't flying to the U.S., and
yes,
that's what's hitting them.
That's right, but they said that the international is strong. And as an airliner, you make more money on international flights than domestic. So if it's a one-for-one swap, if every person that's going to the U.S. is going overseas to Europe, they're going to make more money that way. And so the opportunity for Air Canada to sort of recover back up just to where it was in November is like 35% upside.
Okay, so you would dip in at this point?
Yeah, I mean, last week was better, and a couple weeks was better, even that. But even at today's price, I still find it attractive.
Which is 18 and change.
Yeah.
Got it. Okay, let's go to your next pick, which is Blue Owl Capital, New York Stock Exchange. Blue Owl, tell me about them and what you like about Blue Owl.
Well, we talked earlier in the show about Brookfield and how I thought it should be a core position. And Blue Owl is another alternative investment manager. And they're sort of riding three trends in the investment world, and the first being sort of private credit, where it's primarily direct lending.
Okay.
And then the second one is that they're capitalizing on sale leaseback transactions with investment-grade companies that want to monetize their real estate.
Okay.
And then the third one is that they're heavily involved with bringing alternative investing to the retail investors through the broker network. They're doing that in the United States and do that in Canada. Now, in terms of numbers, they had their investor day in February, when the stock was a lot higher than where it is today.
Okay.
And they provided an outlook for 20% compound annual growth of their fee-related earnings, which is quite phenomenal. And now, because of what's going with the uncertainty in the economy and all, maybe it's not going to be 20, maybe it's going to be 15, or maybe it's only 10. But it also yields a 4.5% dividend. So the combination of that growth outlook and the attractive dividend makes it attractive at today's price.
Got it. Okay, so that was Blue Owl Capital. I do want to get to your next pick, which is Pinterest, which is an interesting one. Pinterest has now been around for a long time. It's sort of a visual display. People decide how they want their flowers to look or their wallpaper to look, and that's where they turn. But how do they make money, and is there room for growth for Pinterest?
Well, no, it's interesting you say that. It's been around a long time, and your observation of the company is correct. But what I don't think people realize or appreciate as much is that things have changed. And so 2.5 years ago, new management came in, and they've really improved the site. And they're using artificial intelligence to make their content more relevant to the user, and even the ads more relevant to the user. They're in a sweet spot where they've been able to increase the number of ads that they show on their site and still have increased usage by users. And so they just announced 16% revenue growth last quarter, beat expectations, they raised their guidance. And the revenue growth for this year is 14%, but it's trading less than 19 times earnings. And you have to understand, why is it trading less than 19 times earnings for a company growing that quickly? And that's just because I don't think people have sort of bought in, or people still have an image of the old Pinterest, but not the new Pinterest that is really starting to shape up with the new management.
And it's widely used, and people are still using it. I feel like people used it years ago, and as you said, kind of moved away or forgot about it.
Well, actually, with the last quarter announcement, they announced that their number of users was increased 10%. Year over year.
So they're still gathering people.
And it's accelerating. It's actually picking up. It's actually picking up speed. The number of new users coming on.
Pinterest is one to watch as well. Do got to leave it there, Teal. Thanks for coming in. Appreciate you joining us on the program today.
Thanks for having me.
And we will see you again tomorrow. Thanks for watching us on Market Call. Let's take a look at the markets as we head to a break. Again, we'll see you tomorrow.